Now, those of you who have been following me know that about 4 months ago, back in February, we said there's a high chance that the bull market has already begun. Now, sadly, not everyone listened, right? Because they rather listen to all these doomsday porn stars out there where they said, a global recession is inevitable in 2023, back in 18th of November, right? The stock market will fall 25%, Deutsche Bank. And then the IMF chief warns of a tough year for the world economy, 2nd of January. And then sell-off warning by Marko Kolanovic, who's outright negative, 24th of January. And Michael Burry at that time said, sell. That scared the shit out of a lot of people, right? And then in 21st March, Jeremy Grantham said that brace for the S&P 500 to plunge 50%. The Economist said on 22nd of March, Fed rate hikes will trigger a downturn of greater speed and magnitude than the Great Depression. So again, this is classic textbook. If you study all the past bull markets, they all were born on pessimism. They grew on skepticism. It always happens like that. Everyone is pessimistic, everyone is negative, and that's when the bull market begins. But that's exactly when you need to start investing. And now that the market is already up 20% from the lows of last year, and the S&P is up 10% year to date, now finally, the mainstream media says it's official. We're in a bull market. Well, it's a bit late, right? Well, actually, it's not late. It is the start of a bull market, and people ask me, how long will bull markets last? Well, they could last 3 years, 5 years, 10 years. So the good news is we are just at the start of a new bull market that could last for many, many years. But I suspect that we are going to go through a correction. That means stock price is going to fall for the next few months. Now, before you bears get very excited, get an orgasm, let me explain further. But before that, remember that no one can predict exactly where the stock market is going in the short term. We are all guessing. I'm guessing as well. And remember, I keep saying that my decisions on whether to buy or sell stocks, whether for investment or trading, has nothing to do with these short-term predictions or forecasts. I make all these forecasts just for entertainment purposes, right? So even if I expect the market to correct down the next few months, am I going to sell my stock? No, I'm not selling any of the stocks which I'm invested in. I hold them through the ups and downs. But if the market goes down in the next few months, which it could, then I'll be very happy adding more shares to my investment portfolio or selling cash secured puts to earn good premium, right? Now, same thing for when I do swing trading, when I trade stocks in the market, right? So my decision to trade stocks is not based on predictions or forecasts. It's based on trade setups. So in other words, the next few months, even if I expect the market to go down, but if I see certain trade setups that are bullish, I will still go long on certain stocks. Because remember that during a correction, certain stocks can still go up, right? But at the same time, if I see certain setups where I think it's a bearish setup, I will short certain stocks. So again, remember that professional traders, we trade based on the individual setups and price action of the stock, never based on forecasts or predictions of the entire market, right? Same thing with investing. In investing, you hold and you buy high quality companies based on the fundamentals of the individual businesses, and you add shares as long as they are undervalued, right? So when I say that I expect a correction, it's something that may or may not happen, but it's important to be psychologically prepared when it happens and to know what to do when it happens, all right? So with all that, why do I expect a correction? Well, for a few reasons. Number one reason is this. When the media starts to get very bullish, I tend to be a contrarian, right? I tend to get a bit bearish, right? Because when everyone out there thinks that, we're going to die, it's a bear market, we're going to die, I get very bullish. But now that the media says, hey, we're in a bull market, then I'm like, oh shit, then we could go down, right? So, but there's a small reason. But the main reason why I think we may get a correction in the next few months is because, simply speaking, the market is technically a bit overextended. Okay, so what do I mean by that? Now remember that nothing goes up in a straight line. Even in a bull market, even on an uptrend, you never ever see it go up in a straight line. It doesn't work that way, right? Prices move in wave patterns. Remember that. It's always wave up, wave down, wave up, wave down, wave up, wave down. It's like breathing pattern, as I keep teaching people, right? Breathe out, breathe in, breathe out, breathe in. So no matter how strong you are, you can't breathe out forever. You gotta breathe in before you can breathe out again. So recently, the market has been breathing out, right? Especially certain individual stocks have breathed out a bit much. So you gotta expect a bit of a breathing in. So if you look at the S&P 500, okay, it is slightly a bit extended, right? So again, you've got this, breathe out, breathe in, breathe out, breathe in, breathe out. So it's kind of like breathing out right now. So it could go a bit further, like breathe out, but you gotta expect that it's gotta breathe back in again, and it may come back down to retest this level, right? Which was a resistance. You can see a break of the resistance. It may retest that resistance as a support before heading higher, okay? So that's the S&P 500. Now, if you look at the NASDAQ, now the NASDAQ, of course, is the outperformer this year. And it's been a bit extended, right? So if I put in all the different moving averages, you can see again, right? Breathe out, breathe in, breathe out, breathe in, right? And it's breathing out, okay? So what happens after a breathe out? You're gonna have a breathe in, okay? So, no one can predict. It could be a shallow retracement where it retraces back to maybe the 40 EMA, which is blue dotted line, or retrace back to the 50 moving average, or even, retrace to this 100 moving average. We can never predict exactly where it's going to retrace to, but you got to expect that we're going to have some kind of healthy retracement, healthy correction, especially in the tech stocks before heading higher to the end of the year. Now, again, the other reason is because we are entering a seasonally weak period in the markets. So you can see from this chart, courtesy of Carson Research, credit to them, that you've heard the phrase, sell in May and go away, right? But ironically, like I've said before, that May itself is not actually bearish. Historically, May tends to be slightly bullish, as you can see, right? Slightly bullish. But historically, June tends to be bearish. You can see that June tends to be slightly bearish, except, interestingly, during pre-election years, it tends to be a bit more bullish. So you never know, right? Because this year is the US presidential pre-election year. So you never know. June could be bullish as well, right? I would give it 50-50 over here. Now, July historically is bullish, right? As you can see, but the weaker months would be in August and September, based on seasonality, right? And then October, November, December would then be very, very bullish. So again, because of seasonality, we can expect a bit of weakness in the markets during this time. So again, what do we do, right? Now, as an investor, knowing this, do I say, okay, I'm going to sell all my stocks and buy back cheaper? No, I'm not, right? Because it's not worth the while, because these are great companies which I'm holding. So even if I anticipate that it's going to go down a bit by 5-10%, who cares? I'm just going to hold it through, because the danger is you want to sell, get back lower, but sometimes before you get in, it runs off without you. So great companies, I'm not selling, I'm holding them through even these seasonal weaknesses. But for certain stocks that I feel are way overvalued, extremely overvalued, yeah, I'll sell some of my positions. Like you guys know, I've shared, like I own Nvidia, and my intrinsic value for Nvidia is about $220. So right now, close to 400 is like almost 90% overpriced. So while I love the company, it's a high quality company, I believe the company will be higher in 5 to 10 years, but I think in the short to medium term, it's a bit overpriced. I decided to sell slightly more than half my position, right? Because it's really overpriced. But for stocks like Meta, for example, Meta and Amazon and Salesforce and Amazon, okay, although it's a technically overextended as well, but I'm not selling them. Why? Because they are still undervalued based on my intrinsic value calculations. That's why it's really important as an investor not to guess. Is it expensive? Is it cheap? It's not about guessing. It's about looking at the actual intrinsic value. And that's why one of the most important things that you learn in my community, in my course, is how do you value a business using a discounted cash flow model. That's the most important recipe or secret sauce in the recipe, if you will. All right. Now, Larry Williams, who is one of the very few people I respect because he's a legendary trader. He started trading before I was born, and Larry Williams is actually one of the best in market forecasting using cycles, right? And recently he released his YouTube video. Go watch his YouTube video. And he had this 2023 cycle forecast that I thought was pretty interesting. And like I said, no one can predict for sure. It's not 100%. But so far, his cycle forecasts for the last 12 months have been pretty spot on, okay? So for Larry Williams, he also expects a correction, a healthy correction in the next 2 months. And I think he's kind of like calling a bottom on the 15th of July before rallying through the end of the year. But again, who knows exactly where's the bottom and how deep is it going to go, right? But what I can say is that high chance there should be a bit of a correction. So for those of you who have missed out adding shares of your favorite companies, here could be another chance to add on if they reach undervalued levels and to strong support levels. There could be a chance to add on to positions. All right. Now, another question people have would be, Adam, for the rest of the year, do you think the market can go further? I mean, so far the S&P is up 10% for the year. Do you think it can go further? Now, again, no one can predict, right? We're all guessing. So all I can do is I can look at probabilities based on historical patterns. So let's look at some probabilities going forward, okay? Now, remember that on any given year, the market goes up an average of 9.5%, all right? This is going back to 1950. So if you look at the last 70 years, right, and you just hold stocks through the ups and downs, you're getting an average of about 9.5% a year, okay? And over 70% of the time, the market goes up. 30% of the time, the market goes down on any given year, okay? But a year following a negative year has a higher chance of going up. So last year, as you guys know, was a negative year, right? Last year, the S&P closed 19% down, okay? So after a negative year, we have got an 80% chance of being higher the following year, which is this year, with an average return of 15%. Again, credit to Carson Research for this table that they did, right? So in other words, statistically, we have an 80% chance that we're going to end up positive this year, 80% chance, and we're going to get a return of 15% on average. So far, we're up 10%. So historically, statistically, we should be up another 5% more for the next 6 months, okay? But if you ask me personally, I think we could end up higher, right? My personal guess is that we end up over 20% for the year, which means we've got another 10% more to go. That, again, that's my guess. I could be wrong, right? You never know, but that's my guess, okay? Here's another interesting piece of historical data. So again, remember that a bull market is defined as prices closing 20% above the previous bear market lows, which has just been accomplished. Now, if you go back to the 1950s, this has happened 13 times before, okay? And out of the 13 times it happened previously, 6 months later, the market was up 10 out of those 13 times, which is roughly about 77% probability. All right. So in other words, after a bull market is confirmed, we've got a 77% chance that will be higher in 6 months, which is the end of the year, with an average return of 10% more in the next 6 months, right? So like I said, we're up 10% so far this year. another 10 more percent, total 20%. So this kind of like confirms my guess, all right? Now, 12 months from now, which would be roughly June of 2024, the chance of the market being higher would be, based on historical track record, would be 12 out of 13 times, which is roughly about 92% probability with an average gain of 17.7%. Okay, so once a bull market has started, again, the chance of the market being higher 6 to 12 months from now is a lot higher than the chance of it being lower. We can't predict the future. All we can do is we look at probabilities and make decisions based on what's the highest probability going forward. Now, for those of you who missed the first 8 months of this bull market and you're wondering, hey, are there still some bargains left that I can buy? The answer is yes, all right? So remember that for the first 8 months of this bull market, not every single stock, not every single sector has participated yet or so far. So far, the bull market has been driven mainly by these three sectors: technology stocks, communication services stocks, and consumer cyclical, or also known as consumer discretionary stocks. So these are the ones that have been leading the way, all right? So you find that there are sectors that have not caught up yet. They are going to play catch up next, okay? So industrials, for example, basic materials, financials, real estate, healthcare, consumer defensives, utilities, and energy. So these are where we still have bargains in the market. But again, don't just buy a stock just because it's in that sector. You have to make sure that it's a high quality stock that meets all the fundamental criteria. That's what we teach in our value investing course. Only buy the top 1% of companies within a certain sector, right? So I'll give you a few examples right now. Now, out of all these sectors that have not yet caught up, my favorite sector would be healthcare. I love healthcare because healthcare is both a defensive sector as well as a sector that has got pretty good secular growth. And there are some good healthcare companies that are still very, very undervalued, all right? So for example, you can look at stocks like Johnson & Johnson, Abbott Laboratories, Viva Systems, Thermo Fisher, quite a number of those around, or HCA Healthcare. There are some high quality companies that are still undervalued, right? Again, this is not a recommendation to buy, right? Remember that before you buy a stock, you got to do the research. You got to go through the steps, make sure it's a great company, make sure it's undervalued, buy at the right support levels. We cover all that in detail, of course, in our courses and in our community, right? Industrials have been positive for the year, but again, there's still a bit of catching up to do. I mentioned also last time that so far the rally has been driven by large companies, large caps, companies that are above $10 billion. The S&P 500 is made up of the large cap companies, right? But the small cap companies, companies that are below $10 billion, in fact, below $2 billion, they are still very, very cheap. So if you take a look at the IWM, which is the Russell 2000 Small Cap Index versus the S&P, you can see the Russell Index is at a historical low versus the S&P. So small cap stocks are very cheap right now. That's where you can find a lot of bargains, okay? Now, I'll be having a live webinar coming up pretty soon where I'll share more about this. But I have been looking at small caps as well. For those of you in my community, one of the small cap stocks that I entered recently. But again, remember that small cap stocks tend to be riskier. They tend to be not as strong as large caps. So you only want to buy the very high quality small cap stocks, right? So one of the ones that I entered recently is actually Winnebago, which is ticker symbol WGO. Yeah, in fact, I recently shared with my community on the UIP Ultimate Investors Playbook that I, bought an initial position into Winnebago, right, at $58.89, and this was back on the 1st of May. That's right. So why did I enter this stock? Well, you can see that Winnebago is a small cap company that is, in my opinion, very, very undervalued. If you take a look at my intrinsic value calculation, using a discounted free cash flow model. And I'm using a very conservative growth rate, right? I'm only assuming the company's going to grow at about 5%, right? And based on the recent free cash flow, this gives me an intrinsic value of $123. So, I bought it at about $58, right? So I bought it when it was like 52% undervalued, half price. Like I said, small cap stocks are very, very cheap, but you got to buy the high quality ones, the ones that are showing consistent growth in revenue, free cash flow, and profits. All right, Winnebago is one of them. And again, it's not a recommendation for you to buy. I'm just sharing with you how I find great bargains in the market. Now, right now, since I bought it at $58, it's gone up to about 74, but it's still about 47% undervalued, right? So this is a small cap industrial stock. And again, if you take a look at the price action, you can see that it is on an uptrend, right? Wave up, wave down, right? Wave up, wave down. So it is on an uptrend right here, right now. So even though we are in a bull market now for the last 7 months, there are still a lot of bargains in the market. Still a lot of very high quality companies that are still very, very cheap. And again, in my future webinars, I'll share with you some of the ones that are available, and I'm going to teach you how to find your own as well. So I'll see you guys in the next coming videos and live webinars. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.